Welcome to FX Smart. Are you ready to unlock the secrets of supply and demand trading and elevate your trading game? In this comprehensive course, we're diving deep into the world of supply and demand, a powerful concept that can significantly boost your trading profits. Here's what we'll cover: understanding supply and demand, learn the fundamentals, and discover why mastering this concept is crucial for successful trading. Identifying key zones, I'll show you how to accurately draw and locate supply and demand zones on your charts. Tracking and timing, find out how to track these zones and determine the perfect moments to enter trades. Exclusive strategies, get an insider's look at my personal, secret strategy for trading supply and demand effectively. Don't miss out on this opportunity to transform your trading skills. Make sure to watch the entire video and take the first step towards mastering supply and demand with FX Smart. Subscribe now and let's get started on your journey to trading success. What is supply and demand? Supply and demand in trading essentially represent aggressive buying and selling. We focus on these strong movements because they indicate that major players, such as big banks and institutions, are actively participating in the market, driving prices in a particular direction. Take a look at the candlesticks here. Large, bold momentum candles signal substantial aggressive selling, showing significant momentum and volume pushing prices downward. On the other hand, the white momentum candles on the right indicate intense buying pressure, with a lot of buying activity propelling prices upward. When trading supply and demand, these momentum candles are crucial indicators. They reveal that smart money is influencing the market. Look for these signals to understand where the major market moves are happening. On the other hand, if you notice small candlesticks like these, this is not a sign of strong demand. These small candles represent minor buying activity, which we refer to as baby buyers. We don't want to see such small candles because they indicate a lack of volume and momentum from the smart money. Why should you trade supply and demand? Here's my reason. Trading supply and demand allows me to align my actions with the major market players who have substantial financial influence. By observing and reacting to price movements driven by these big players, I can make more strategic and profitable trades. Supply is identified by sharp declines in the market, while demand is seen through strong upward movements. This approach helps me pinpoint when these key players are entering the market. I look for strong momentum candles, as they indicate that the major players have entered the market. As retail traders and brokers, we don't have the financial power to move the market ourselves. However, these big players are dealing with millions and billions of dollars, and their activity drives significant price movements. Imagine you have insider information that the big players, the smart money, or billionaire traders are buying at a key level. Would you buy as well? If you said no, you'd be missing out on a huge opportunity. It's practically free money. Insider trading aside, knowing that these influential players can move the market makes it clear that you should follow their lead. You want to ride the wave with them, not against them. Unfortunately, many retail traders make the mistake of trading against these powerful market movers. Now that you understand this concept, how to identify supply and demand zone. The next step is to look for at least 3 momentum candles in a row. For example, here we have identified 3 consecutive white momentum candles. You can have more, like 4 or 5, but the minimum is 3. Remember, you do not want to see small candlesticks. You want strong momentum candles that indicate the presence of the big players. In this example, we'll use these 3 white momentum candles. The following step is to find the area where the move started. This upward move began from the previous candle, which is the one just before our momentum candles. To mark this area, take your rectangle tool and draw a box around the high and low of the previous candle. This box becomes your demand zone. Next, we wait for the price to come back down to this demand zone to enter a buy trade. In this case, the price did exactly that. It came down to retest the demand zone before shooting back up. If you entered a buy trade here, you would have made a significant profit. Here's another example. We have several momentum candles in a row right here. Use your rectangle tool to box the previous candle, marking the high and low, and then extend it to the right. This creates your supply zone because the last time the price was here, it was pushed down significantly. Now, we wait for the price to come back up to this supply zone. Look at what happened next. The price managed to rise back to this area, and then it collapsed. Did you see that? The price literally went back up to the supply area we marked and then dropped sharply. This is the first method for identifying your supply and demand zones. If you're an experienced trader or a beginner without enough capital to trade, I highly recommend visiting the Funded Next website. Funded Next is the largest capital provider for traders in the financial markets. Traders worldwide have received funding through this company and transformed their lives. You can test your skills by participating in their free competitions and benefit from the rewards. These competitions are held monthly, with valuable prizes awarded to the best traders. Funded Next is the only company that pays you 95% of the profit from your trading account. We have a special offer for you. If you sign up through our link and purchase one of the Funded Next challenge plans, you can enjoy a 5% discount. Share this news with your friends and take advantage of this discount. Don't waste time. Join this large community today and change your future. Use the link in the description to sign up. Another method to consider is observing consolidation. As you can see here, the price is moving sideways, not making any significant progress. To analyze this, you can draw a box around the entire consolidation area. Notice how the price moves. It goes up and touches the top of the consolidation box before heading back down. The third method involves identifying areas with wicks. Wicks indicate that the price is being rejected at that level. For instance, you can see multiple long wicks in this area, indicating strong rejection. Draw a box around this region and extend it. Notice how the next time the price came down to this level, it shot up significantly, marking a strong demand zone. Similarly, there's another supply area where multiple long wicks form, showing consistent price rejection. By drawing a box around this area and extending it, you can see that when the price returned to this level, it dropped all the way down to the demand zone. Now that we understand how to identify supply and demand zones, we need to learn how to trade them. Supply and demand trading strategy. Step 1. Identify the price trend in the 4-hour and 1-hour time frames. What is an uptrend? In trading, an uptrend is a period where the price consistently moves higher, creating higher highs and higher lows. This indicates that buyers are in control, pushing the price upwards. To identify an uptrend in the 4-hour and 1-hour time frames, follow these steps. Look for higher highs and higher lows. Check if the price consistently makes higher peaks and higher troughs. Use trend lines. Draw an upward sloping trend line connecting the higher lows. This visual aid helps confirm the upward direction. Check moving averages. Apply moving averages 50 period and 200 period to the chart. In an uptrend, the shorter moving average 50 period should be above the longer moving average 200 period. Step 2. Identify the latest swing highs and swing lows. Identify swing highs. A swing high is a peak reached by the price before it starts to fall. Look for a high point that is higher than the points immediately before and after it. Mark the highest price in this pattern as the swing high. Identify swing lows. A swing low is a trough reached by the price before it starts to rise. Look for a low point that is lower than the points immediately before and after it. Mark the lowest price in this pattern as the swing low. Step 3. Identifying demand zones on the 15-minute and 5-minute time frames. These shorter time frames allow you to pinpoint precise entry and exit points. Look for momentum candles. Identify several consecutive momentum candles that indicate strong buying activity. These candles should have larger bodies compared to the preceding candles, signaling significant demand. Mark the previous candle. Once you spot the momentum candles, locate the candle immediately before this move started. This is crucial as it represents the origin of the demand. Draw the demand zone. Use your rectangle tool to draw a box around the high and low of the identified candle. Extend this box to the right, creating your demand zone. Wait for price to retest the zone. Monitor the price action as it approaches the demand zone. When the price enters this area, observe the formation of bullish candlestick patterns that indicate a potential reversal. Once the price retests the demand zone and bullish candlestick patterns form, enter a buy trade. Set your stop loss below the demand zone to manage risk effectively. Plan to exit the trade when the price reaches the supply zone. This ensures you lock in profits as the price is likely to encounter resistance. By following these steps on the 15-minute or 5-minute time frames, you can accurately identify and trade demand zones, capitalizing on the movements driven by significant market participants. Step 1. Identify the price trend in the 4-hour and 1-hour time frames. What is a downtrend? In trading, a downtrend is a period where the price consistently moves lower, creating lower highs and lower lows. This indicates that sellers are in control, pushing the price downwards. To identify a downtrend in the 4-hour and 1-hour time frames, follow these steps. Look for lower highs and lower lows. Use trend lines. Draw a downward sloping trend line connecting the lower highs. This visual aid helps confirm the downward direction. Check moving averages. Apply moving averages 50 period and 200 period to the chart. In a downtrend, the shorter moving average 50 period should be below the longer moving average 200 period. Step 2. Identify the latest swing highs and swing lows. Identify swing highs. A swing high is a peak reached by the price before it starts to fall. Look for a high point that is lower than the previous high but higher than the points immediately before and after it. Mark the highest price in this pattern as the swing high. Identify swing lows. A swing low is a trough reached by the price before it starts to rise. Look for a low point that is lower than the previous low and lower than the points immediately before and after it. Mark the lowest price in this pattern as the swing low. By identifying these key points in a downtrend, you can better understand market movements and plan your trades more effectively. Step 3. Identifying supply zones on the 15-minute and 5-minute time frames. Switch to the 15-minute or 5-minute chart. These shorter time frames allow you to pinpoint precise entry and exit points. Look for momentum candles. Identify several consecutive momentum candles that indicate strong selling activity. These candles should have larger bodies compared to the preceding candles, signaling significant supply. Mark the previous candle. Once you spot the momentum candles, locate the candle immediately before this move started. This is crucial as it represents the origin of the supply. Draw the supply zone. Use your rectangle tool to draw a box around the high and low of the identified candle. Extend this box to the right, creating your supply zone. Wait for price to retest the zone. Monitor the price action as it approaches the supply zone. When the price enters this area, observe the formation of bearish candlestick patterns that indicate a potential reversal. Enter the trade. Once the price retests the supply zone and bearish candlestick patterns form, enter a sell trade. Set your stop loss above the supply zone to manage risk effectively. Exit the trade. Plan to exit the trade when the price reaches the demand zone. This ensures you lock in profits as the price is likely to encounter support. Let's review a few examples. Here, the price is in an uptrend on the hourly time frame because it has formed higher highs and higher lows. Therefore, we look for buy signals during pullbacks. You can use moving averages to identify the market trend. Now that we have confirmed the uptrend, we switch to the 15-minute time frame to identify demand zones. Here, I am looking for bullish momentum candles. As you can see, there are 3 demand zones. I draw these zones and wait for the price to reach them. As the price reacts to the demand zone and gets rejected, I look for a bullish candlestick pattern to enter a buy position. When the bullish candle closes, I open a buy position and set my stop loss below the demand zone. I wait for the price to reach the supply zone and then exit the position. Please like the video and subscribe to the channel. Thank you. I believe now you can quickly identify supply and demand zones just by looking at the chart. As you can see, the price is in a downtrend. I can identify several strong bearish momentum candles, indicating that sellers are in control. Therefore, I switch to the 15-minute or 5-minute time frame to draw the supply zones. I draw several supply zones on the 5-minute time frame and wait for the price to reach one of these zones. As you can see, the price reacted to the first supply zone and closed with a bearish engulfing candle. I can now open a sell position. I place the stop loss above the supply zone or at the recent swing high and wait for the price to reach the demand zone to exit the trade. Let's see the result. I hope this video helps you achieve substantial profits in the market. Trading in supply and demand zones is one of the most effective and precise strategies in financial markets. I have created additional videos on how to identify these zones and provided detailed strategies for entering and exiting trades. You can find the links to these videos in the description, and you can also check out more smart money videos in the Smart Money playlist. To support us and help us create even better content, please like this video and subscribe to the channel. Share this video on your social media and send it to your friends. Your support motivates us to keep producing quality content. Until the next video, happy trading and stay successful.